Hello everyone, my name is Keith Sprauer, Chief Investment Officer here at Global Wealth Advisors, and this is the 2023 second quarter outlook. A lot of what I want to cover today comes from refreshed data, which I feel gives us the information we need to look forward. And specifically, a lot of this is around the Federal Reserve and the economy. As we briefly look back into Q1, one of the big surprises in that first quarter, specifically in March, was the crack we saw in the banking sector, with a few banks on the brink of collapse. The issue revolved around certain banks having very concentrated client bases, and the fact that there has been a tremendous amount of outflows from bank accounts that are still paying less than 0.25% into safe money market funds paying well over 4%. The lessening of deposits prevents banks from turning some of those assets into loans and mortgages. At the same time, the fixed income securities they held on their balance sheet lost a great deal of value given how aggressively the Federal Reserve has been increasing rates over the past year. This surprising event changed a great deal of what was being focused on in the markets and in the economy as well. As was widely reported, there was a quick and coordinated action from the Federal Reserve, the U.S. Treasury Department, and the FDIC, as well as large banks. Very similar to the great financial crisis, there's been a great deal of talk around whether or not we should have seen this much governmental and institution support for these organizations. Regardless of which side of the discussion you come down on, you can't deny that it's caused a change in forward-looking projections of many. As we moved through the first quarter, we saw reasonable performance from almost all asset classes, which is a little surprising given all the unknowns we are still working through. Keeping in mind they're only through the first quarter of the year, but through that quarter, we saw the international markets in particular have strong returns, mainly due to the fact that the dire predictions around their recessionary forces, particularly in the energy space due to the reliance on Russia and Ukraine for oil and natural gas, never developed. The most recent meeting of the Federal Reserve Open Market Committee happened in March, with the next meeting taking place in May. And until the banking issues surfaced, it was expected that the Fed would increase the Fed funds rates by about 0.5%. By the time the meeting happened, the upheaval from the banks had quieted down a little bit, and the Fed kept moving forward by increasing 0.25% or 25 basis points. Now, March was a meeting where the Fed governors projected where they feel some of the economic metrics would be over the next few years. As I've discussed before, when the market is projecting something different than the Fed themselves are saying, it leaves the door open for volatility. And the Fed is saying that they expect to raise rates another 25 basis points this year, where the market is projecting that there won't be any more hikes. Another key in the projections are the GDP numbers. They have year-over-year growth for 2023 GDP of about positive 0.5%. We know that advanced estimate of Q1 23 GDP is expected to be between 2.5% and 3%, which means that to get to a yearly number of what they're showing is 0.4%, we would need to see some negative GDP quarters for the balance of the year. That alone would solidify the recessionary outlook. Another example of market and FOMC dislocation is shown in this chart from High Mount Research. And I will say that I've seen these with varying projections as the days go on. But again, this is from the time of the most recent Federal Reserve meeting. And what we're looking at here are the lower bounds of the Fed funds target rate, which currently is at 4.75% to 5%. You can see no projected change for the May meeting remaining at that lower bound of 4.75%. Now this may change each meeting, but if it were to hold, this is saying that by the end of this year, the Fed will likely hike one more time for 25 basis points or 0.25% to get to a terminal range of that 5 to 5.25% or a lower bound of 5%, which is the orange December number on the far right. Again, according to this data, by the end of the year, the market expects that lower bound of the Fed funds rate will be 3.75%. Or another way to say it is that the market is expecting the Fed to cut rates over the balance of the year by 120 basis points or 1.25%. That's enough of a discount for someone to be wrong. In my view, if the Fed is wrong and they have hiked too much to the point of needing to cut 125 basis points, that's not a mild recession. We would be trying to rebound from something more serious. And if the market is wrong and the Fed doesn't cut by over 1%, the market levels and expectations are too high, having built in much more reasonable interest rate levels, cost of capital, mortgage rates, and so on. Those disappointing expectations would cause quite a bit of volatility in the market as well. Let's look at some of the inputs that the Fed is using to make decisions. We know their preferred inflation measure is the Personal Consumption Expenditure Price Index, or the PCE. And as we've discussed in the past, the PCE and the CPI, they follow similar trends. The PCE is preferred by the Federal Reserve. It does tend to be a little more inclusive, tracking employer-provided insurance, Medicare, Medicaid, and some other items. Here, the headline number on the left and the core number on the right aren't too different, but still elevated from a long-term target of closer to 2%. Many feel at this point, with rate hikes still working their way through the system, inflation will continue to come down on its own to the target rate over time without the need for much more restrictive policy. And as we move into the summer months, some of those peak inflation numbers from last year will be falling out of the year-over-the-year data, causing the numbers to come down as well. The other issue for the Fed is the labor market is still strong. In the post-World War II era, the average unemployment rate here in the U.S. has been about 5.75. We're currently at 3.5. The Fed wants to see this number higher, so the demand side of the equation will slow and inflation will come down quicker. As you can see from this graph, though, it hasn't moved much since January of 2022. So the rate hikes to date haven't had a great deal of effect on this metric in particular. And to give you a sense of what a change in the employment rate means in jobs, if we were to get to the projected rate of 4.5% by the end of the year, which is what the Fed is predicting, from the current rate of 3.5, it would mean a loss of approximately 1.5 million jobs. It's important to be reminded of the scale of the current rate hike cycle. It's been tremendous. The chart on the left shows various tightening cycles since the Great Inflation, which lasted from 1965 to 1982. 2022's tightening are in orange, and although we've seen substantial tightening in the past, the speed at which this has happened is the key, given that it can take 12 to 18 months to have the maximum effect on the economy. We've looked at the graph on the right in the past, which shows continued slowing of the growth of money supply. The money supply needs to be growing, and money needs to be moving through the economy in order to prevent a recession. One of the items that has been happening before the banking issues came up in March was the fact that financial conditions were tightening. And what that means is that banks aren't lending as aggressively as they have in the past, as they're being more cautious about who they lend money to. We saw financial conditions begin to tighten as we moved into 2023, and it certainly isn't going to slow down with the issues we saw in March with the banks. These graphs, particularly the graph on the right, shows that more and more banks as a percentage are tightening up their lending standards, and the graph on the left is showing us how much of a cushion banks are keeping in-house to protect themselves from unexpected losses. So not a surprise that this turned up at the same time as lending standards have increased. One of the big issues that has historically been a concern when we are in these periods is that banks really cut back on lending and borrowers find it hard to get credit. And this is what's known as a credit crunch, which in the extreme can deepen a recession. My view is that we aren't in that situation currently, but if it becomes a possibility, historically the way to get out of it is for interest rates to be much, much lower than they are. We've spoken in the past about the declining savings rate due to the higher prices of goods and services, as well as the increase in credit card debt and credit card payment delinquencies. But as a reminder, we can look at savings definitionally as your disposable income minus spending. So in order to increase savings, you either need to have more disposable income or decrease your spendings. So as savings decline or stay low, consumer borrowing increases, which you can see in the graphs to the right. This causes a weakening of household balance sheets, and as they continue to lever up, it puts them into a more precarious financial situation. They'll eventually slow their spending, which in turn would hurt company profits and slow down the economy. One of the economic indicators I like to watch and that we've looked at before is the leading economic indicators, or the LEI. In this instance, we're graphing the LEI index against real GDP. And as you can see, it tracks pretty closely. As we continue to see the decline in LEI, we would likely see GDP remain muted. Historically, LEI bottoms about 18 months after interest rates peak. And if this history holds, we still have more declines to come. As we're talking about leading indicators, one that's used and talked about extensively to predict an upcoming recession is the shape of the Treasury yield curve. And whether you're using the 2-year to 10-year or the 3-month to 10-year Treasury as used in this graph, the yield curve remains substantially inverted. And an inverted yield curve shape, particularly if it's been inverted for a while, as we've seen, is a leading indicator of a recession. When you combine this with the fact that the Federal Reserve has been aggressively hiking into a slowing economy, the decline in leading indicators, the softening of forward earnings, means to me that we will officially be in a recession before the end of the year. So the big question is, where will it fall on the scale of mild to severe? And with the expectation of the Fed stopping and rate cuts possible on the horizon, I would say we would be closer to the mild side of the recession scale. I'd like to have a graph on housing because it's such a big part of the economy and consumer spending. I've included here a Case-Shiller Home Price Index slide that shows what many are saying about the housing market. But I will say that I've been watching residential real estate, and though you see price adjustments, I can say anecdotally anyway, that prices aren't being slashed on houses for sale unless they aren't priced properly to begin with. So I feel there is still some regionality around it. And though higher mortgage rates have slowed some buyers, those rates are still historically reasonable, though quite elevated from where we were a few years ago. This is a graph that I feel is very important. It compares corporate profits as measured by operating earnings per share, which is the dark gray line, and capital expenditures, which is the green line. It shows us what companies are earning versus what they're spending. And as you can see clearly, that earnings are dropping while capital spending remains elevated. And by looking at the history of the graph, yes, it can continue on that way for a while, but it doesn't tend to stay that way when earnings per share are dropping. It reverts back, which means earnings would need to increase, which doesn't seem to be expected in the near future, or spending needs to slow, which is more likely. As an aside, we've seen 3 quarters in a row of declining earnings growth, but there has still been spending for all those quarters. This will continue to compress margins even more, which will force companies into cost-cutting measures at some point. So how do you pull all this economic data and Federal Reserve talk into market projections? I'm not looking at the markets and asking questions about, are we in a new secular bull market or a new bear market, but what direction are we moving in the intermediate term? The next few quarters, say, or 6 months to a year. You certainly have to be aware of longer-term trends, but in reality, information changes quickly, and portfolio adjustments are made in relation to the changing data. And when looking at the current environment, in order to be fully behind a bull market going forward, you have to believe there are no other banking issues coming. The Federal Reserve will cut rates over the next few quarters. Inflation will decline meaningfully. Economic growth stays resilient and earnings don't drop. The opposite is true as well. In order to be a bear, you must believe there is a banking crisis with a real fallout to come. That the Fed doesn't cut rates for quite a while, inflation stays sticky or may even bounce higher. As I've said in past outlooks, I feel earnings will be more of a key than anything the Federal Reserve does in the near term, unless they start cutting aggressively. In the upcoming quarters, we will continue to see the effects of higher rates filter through the economy. This will cause earnings to continue their decline and come in over the next few quarters below what analysts are projecting and what the market has priced in, and that's going to cause volatility. We're moving to a reversion back to focusing on the data as bad news is bad for the equity markets and good news is good for the equity markets. The base case scenario I see is that the Fed may have to continue with another hike, given the core inflation number is still elevated and the labor markets haven't weakened to the point they were hoping. Given that timing the market is difficult, having some cash for opportunities makes sense. For particular accounts, global equity diversification also makes sense. And I feel we're getting close to moving some of our short duration fixed income assets into longer duration fixed income. And with that, from all of us here at Global Wealth Advisors, thanks for watching, and I'll speak with you next quarter.